So RPP stands for Registered Pension Plan. This is a private pension plan, a company pension plan. So you pay amounts into the company pension plan. The company or a third party working for the company administers it, and then when you retire, it's paid out. These have become less common over the years as companies are less and less likely to do this, but they are still relatively common, particularly for large and well-established organizations and government organizations in particular. So contributions made by the employee are reported in box 20 of a T4 slip. So the logic here is this is money that the employee had deducted from their paycheck, so they never received it. Therefore, this money that they have had deducted doesn't need to be included in their income, is the overall logic. So current contributions are in box 20. If the contributions relate to a past year, they are reported in box 20 as well, unless they are for years before 1990, in which case they would be in box 74 or box 75. Now, 1990 is now 35 years ago, somehow. So this is going to be less and less common, less and less likely to be seen. Generally, when you have a rule like this, it's because the tax regulations changed at some point, and that's what something like this reflects. The pension adjustment is what's reported in box 52 of a T4 slip. And the pension adjustment is interesting because when you put money into a company pension plan, this reduces the amount that you can put into a RRSP. It affects next year's RRSP limit. So the pension adjustment is, so if box 20 is the amount that the employee put into the plan, box 52 is the employee contribution plus the employer contribution. In general, if a plan is 50% employee, 50% employer contribution, then box 52 would be double what box 20 is. So if the employee puts in 500 and the employer puts in 500, then you would see 500 in box 20 and 1,000 in box 52. However, variations can exist. Obviously, sometimes the percentages are different. So if the employer puts in $1 for every $2 that the employee puts in, then the employee might put in 1,000. And then if the employer puts in 500, then you would see 1,000 in box 20 and 1,500 in box 52. Other things you might see. If there is an amount in box 52, but no amount in box 20, then this means that all of the money was contributed by the employer. If the amount in box 20 equals box 52, then all of the money put in was put in by the employee. Rarely you may see an amount in box 20, but no amount in box 52. In this case, the box 52 amount will show up on another form. Sometimes it'll be on a form called a T10 in certain, I've seen that for certain government organizations. Sometimes it'll show up in box 34 of a T4A in some other scenarios, or if someone worked for different units of the same employer. So if someone works in hospitals and they work for different hospitals, they were paid out by different cost centers, then you might see only one of the T4s has the box 52 for all of them. All right. And Diane, you're asking, if a company offers RRSP matching, would it be included in these boxes as well? Potentially. It would depend on the specific situation, so you would have to look at that. I would expect that to be, but it would really depend on the individual situation, I would say. So RRSPs are kind of their own thing. They're similar, but they have their own rules, so we would want to look at that. With RRSP matching, I suspect it might not affect the pension adjustment, but instead directly the RRSP contribution room. But yeah, in general, if it would affect it, it would show up on the T4 slip. We would expect it to. So the pension adjustment amount shows up on line 20600 for information purposes only. Only the box 20 is directly added into what's going to be deducted, so that shows up on line 20700. Another employment-related thing which is deducted are union or professional dues. So these can be issued in one of two ways. They can show up on the T4 themselves in box 44, in which case they've been deducted directly from the employee paycheck. In some rare cases, they may show up on a separate, well, not rare cases, it's less common, but you may also see them on an official receipt from the union or professional association. I often see this in the film industry where people work for multiple production companies, and then all their union dues are on a separate slip, just to make it easier on the production companies. In general, employers and unions have agreements in place so that if it's being deducted on the T4, the union will not issue a separate slip. In this case, the taxpayer needs to have official receipts from the union in order to claim the deduction. We need to be very careful not to claim the same dollar twice. So if there is a separate receipt from the union, you need to check with the taxpayer and say, oh, hey, is this the same as what's on as this box 44 on your T4? What's the story here? We just need to check into this. So there may be situations where the amounts are duplicated accidentally. Even if this is the case, you can only claim the union dues once. As a general rule, you cannot claim the same dollar twice in taxes. Do note that union dues are not subject to GST or HST, but professional organization fees are. Now, professional organization fees are slightly different from union dues. They can only be deducted if the payment is required for the person to retain their professional status. And furthermore, that status needs to be recognized by law, and the person's position or job needs to be reasonably related to the professional status. So, for example, the Canadian Library Association is a professional association, but membership is not required to maintain professional status as a librarian, and the status as a librarian is not recognized by statute. By contrast, provincial nursing associations require membership to maintain professional status as a nurse. You can't work in British Columbia without this status, and that status is recognized by statute. The last bullet point here is also kind of important. Sometimes you'll have somebody maintaining professional dues to maintain their status in the old professional organization after they leave a job. In the year they leave the job, they had employment income for part of the year, they can still claim this. But if they are not working in a job related to that professional status in the year, then they cannot claim it under this provision. So in later years, you sometimes see retired people maintaining their professional status. If that is the case, they can't be claimed under this provision. Typically, in order to claim, as a general rule in taxes, in order to claim a deduction or a credit, it needs to claim anything. It needs to relate to income in some way. If you do not have income from a job, then the professional dues cannot be claimed, at least under this provision. Pooled registered pension plans, we're going to touch on them briefly. These are claimed on line 20800 together with RSP contributions. We're going to talk about those later in Chapter 8. Any employer contributions are reported on line 20810. These plans are quite uncommon. They started in 2013. Their intention is to provide access to something like a company pension plan for self-employed taxpayers and for employees whose company does not currently provide pension coverage, that is, small companies. So these are instead administered by financial institutions instead of small companies, so that the small companies do not have to deal with a lot of paperwork. PRPPs have not been implemented in many provinces, There doesn't seem to be a lot of pickup on them from what I can tell, but this may vary by region. So they are recognized by statute. They are in the tax code. They are there. That is what they are. But for now, they are still unusual, but you may see them more in the future. Now, sometimes someone has to repay income which has already been paid to them. As a general rule, if the income has been reported on a tax return previously and then has to be returned, this means the person never really received that income. So in the case of people who received COVID benefits and then had to repay them, for example, then they get to deduct that income in a future year. In the case of employment income, it's treated as an employment expense, and it's deducted on line 22900. So again, the key feature would be you received this income in 1 year, you reported it, paid tax on it, then you have to pay it back in a future year. So in this case, you need a letter or receipt from the employer stating that it was paid back. And an example of this might be something like a signing bonus or a contract bonus that you received in exchange for fulfilling certain conditions, and then if you don't fulfill the conditions, you have to pay it back. Something like that. Again, this is relatively unusual, but that is how it would be handled. And again, it shows up as an employment expense. Employment expenses in general are beyond the scope of this course because they can get very complicated very quickly depending on the type of employee. The short version, I would say, is that most people, most of the time, cannot claim employment expenses. However, there are about 10 or 11 categories of special cases where employees can, but all the requirements are slightly different, and that's what makes it kind of a large topic to get into. We're not going to be getting into that, certainly not at this stage of things. Right, but it is an example of a kind of deduction related to employment income that you would see in this step. So after we have calculated net income, all right, well, so to sum up, net income, we calculated it on step 3. All specified allowable deductions are added up on line 23300. These are then deducted from the total income on line 1500. Social benefits repayments, which we'll talk about in chapter 6 and 11, they're deducted on line 23500 to give us the net income on line 23600. So again, just to show you the bigger version of the form, so we add everything up here. Again, we have that net income before adjustments. We total up all the deductions, deduct them here to give us a net income before the adjustments at line 23400. We deduct any social benefits repayment, and then gives us net income at line 23600. And then once again, the net income figure from here is transferred to the top of the next page, where we're going to calculate taxable income. Now, taxable income, it can be helpful to remember that these have different purposes. Get back up. Thank you. So net income is used to determine your eligibility for various credits, such as the GST rebate or the Canada Child Benefit, whereas taxable income is what you're actually taxed on. And we're not going to be going further than this today. So, but again, you can see it follows the same pattern. We have the net income numbers imported up here. We add together various deductions which might apply. And then this gives us our taxable income down here on line 26000. All right. So again, we can see the same pattern. The things are added together here. Amounts for information only, such as pension adjustment or employer contributions to a PRPP put in over here. Taxable income, then we add together various deductions to give us our taxable income. Now, there are a couple of these which relate to employment income, so we're going to touch on them now. the Canadian Forces personnel and police deduction up here, and security options deductions up here, line 24400 and 24900. So the Canadian Armed Forces personnel deduction, this is for military personnel, police personnel who are working outside Canada on an international mission. So this could be something like UN peacekeeping, or being deployed overseas, or for more combat missions, or even for something like, say, embassy security. So personnel in these situations will have an amount declared on the T4 in box 43, and then a corresponding deduction is claimed on line 24400. Fairly straightforward. Security options deduction, so this is for stock options, and for anyone who's unfamiliar, this is when a company gives you an option to purchase stock at a set price and then exercise it in the future. So the benefit is the difference between that price and what the fair market value is at the time of the exercise. The benefit, if any, is in box 38 of the T4 and is included in box 14. Under some circumstances, 50% of this can be deducted, and if so, it'll show up in box 39 or 41, and the deduction is claimed on line 24900. So the taxable income, then, we calculated in step 4 of the return. Again, we add up the allowable deductions. They're added up on line 25700, which are then deducted from the net income, which has been brought forward from line 23600, and the taxable income is reported on line 26000. Now, as you can see here, now there are two other deductions which we haven't talked about from net income related to employment, but we will talk about them. One other deduction, and that is a deduction related to Canada Pension Plan contributions. We're going to talk about that in part 3, so don't worry about it. But these are some deductions related to employment income that would be applied here. So line 60, 61, and added together and then deducted to give us our lower income on line 26000. All right, but what effect does this have on the return? So think about it. A taxpayer is in the second tax bracket, and he has a $2,000 union dues slip. It's not on their T4, but he can claim it. So the taxpayer will ask you, how much does that $2,000 help? $2,000 help on their return. He says, hey, if I claim this, what am I going to save in taxes? So how would you answer that? What is the correct answer? Let's see what you think. Okay, give everybody another 30 seconds. Some of you, a lot of people are thinking hard about this. That's okay. Yes, you may need to check a thing, but if you have the T1 in front of you, there will be a clue in there. All right, some people are still thinking, so I'm going to give you another 30 seconds. Okay, let's see here. All right, so some people are still a little stumped, but most of you have taken a stab at it. That's good. And WebEx is going to make me wait a few seconds for people who had the window open. All right, so pretty even split. Some of you thought there was no tax savings. Some of you thought the tax savings was $300. Some of you thought it was $410. Okay, so that's good. Let me explain what's going on here. So, right. Escape, thank you. Let's pull up the form. So, remember what's happening here. If someone has their net income, total income, so they've got their total income up here, it's added, and then we deduct the union dues. So let's say they're in the second tax bracket. So let's say they're paying $70,000, and then in union dues they have $2,000. Right? So that $2,000 then is, assuming it's their only deduction, so that $2,000 comes down here and is deducted from the $70,000, and that gives us $68,000. And that number carries forward, and assuming they have no other deductions, then that $68,000 then is their taxable income. Right? So that means the $2,000 isn't included in the taxable income. The person does not pay tax on that $2,000, so they are saving effectively whatever the tax would have been at the $2,000. And for amounts that are over $55,000, any dollar over $55,867 pays tax at 20.5%. Which means, remember, they're not paying any tax on that $2,000. If it were included in their taxable income, they would be paying 20.5% of $2,000, which would be $410. Right? So by claiming the union dues, this person saves $410 in tax. This is something which is kind of at the heart of what we do, because people will have questions for us about how much tax do I save if I do this? How much tax do I save if I do that? What if I claim it this year versus that year? So the heart of our job then is figuring out how to claim things in such a way as they save the most tax for someone. How did I calculate that? Again, it's $2,000. The tax on the $2,000, again, remember our tax brackets from last time. The tax on $2,000 is 20.5%. Right? We're going to look at this diagram in an upcoming session, not to worry, but this diagram corresponds to the federal tax bracket. So the second tax bracket is 20.5%. So that $2,000, if it had been taxed, would be in this bracket. 20.5% of $2,000 is $410. Clear? Good stuff. We're going to be doing many examples of that, not to worry. For today's chapter review problems, though, we're not going to be worried about Anything which comes after this point, we're not going to be worried about calculating federal tax or anything like that. Would the answer change if it pushed you into the lower tax bracket? Well, a good question, Jason. Remember, you just asked about the $2,000 itself, right? Let's say that, for example, this person had $57,867, right? Then still the $2,000 would work out to 20.5%. But if the person was in the middle or straddling the brackets, then some would save tax at 20.5%, some of it would save tax at 15%. And that becomes something we need to look at very carefully in cases where someone has a deduction which they could claim in more than 1 year. You want to make sure you're claiming the deduction in a year where the person is in the higher tax bracket so you can get more money back for it. So this relates to something that we're going to be looking at more in the rest of the course as well. Some things you claim in tax only give credit at 15%. Deductions, however, always give reduced tax at the highest rate that applies to a person. This is what I think I told you last time. This is what we call the marginal rate, the highest marginal rate. So deductions save you tax at the highest applicable rate, the highest marginal rate. If someone is already in that lower tax bracket and you can claim the deduction in a future year, it may be more advantageous to do so. And again, that's kind of where our experience and expertise comes in. This is what people are really paying us for in those more complex multi-year situations, how best to apply something. Like, good question, Jason. All right, but what time is it? It is 8:44. Okay, so I don't want to keep you past 9, but we are going to at least start to have a look at the chapter review problems, and then I may briefly go over them in our next session. These chapter review problems are not too tricky, but at this stage of the game, we want to kind of introduce what they are and how they work. So, chapter review problems, then, follow a certain, we want you to practice the methodology that we use when we do taxes. So in the textbook, there is a checklist which walks you through the steps. The first one, read the problem, confirm the personal information you need to complete page 1 of the tax return, then confirm the answers to complete page 2 of the tax return. Then, remember, page 1 and page 2, it's information only. There's no numbers involved. And then you're going to analyze the problem, determine what information needs to be on the return and what does not. And you're going to determine the income that is required to report on the return and what isn't, and then determine any deductions that can be reported on the tax return. All right, and then some questions. So, is there any information which does not belong on the tax return? What should we do with Aaron's email address and so on? So, let me just walk you through the idea here. So, when you're filling things out, you're going to use fillable forms. So again, you would get a copy of your 5010R here, and then you would save it under a different name to your desktop so that you know whose it is. So in this case, chapter review problem 2-1. So person's name is Aaron Smith, so we can save this as the Aaron Smith CRP. So CRP 2-1, Aaron Smith, and that way you're not overwriting the, put that here, there we go. That way you're not overwriting the blank form that you have. Now, bear in mind, you can always download more blank forms either from ULearn or from the CRA itself. Probably in a future session, I'll show you where to get those from the CRA. I don't want to get sidetracked here. And then you just go through and fill out the basic stuff, the information stuff first. Okay, so let's have a look at it. So Aaron Smith. All right, name is Aaron Smith. That's straightforward enough to handle. There we are. Yeah, hang on. That one there. So we put in Aaron Smith. Now, copy and pasting can't always be relied on this. In a PDF or something, it's relatively innocuous, but in some software packages, copying and pasting can give you problems. In particular, when you are answering your assignments in ULearn, the exam in ULearn, do not copy and paste because that can lead to errors. Right, name, straightforward enough. Let's have a look at his. So social insurance number is here, date of birth is here, marital status single. We have an address, your city, YP is your province. Okay, phone number, and we've got his email. So, all right, confirm all the questions here. All right, let's look at the situation. So Aaron is single with no children. Good. We're only looking at simple examples at this stage of the course. He works for Able Construction and was off for work due to illness, and he has a wage loss replacement plan. He has a letter from Able Construction stating he received benefits from the plan. The amount was included on his T4, so $2,400 in benefits on the T4, and we can see that amount is down here in box 40. Good. All right, and this is the first year he's received benefits, so that's straightforward. He also did some odd jobs for another company for $300. The company didn't issue a T4. His only other income is $5,000 from a lottery ticket. Aaron is a Canadian citizen, but he doesn't want to supply information to Elections Canada. He doesn't want to provide his email address to the CRA. He lives outside of a census metropolitan area. That is for considerations of the carbon tax rebate, which doesn't apply in British Columbia, but that's what that's referring to. And a couple of years ago, he inherited $150,000 from his Uncle Charles. He invested the whole amount in a purchase of a piece of land in Florida, where he expects it to increase in value and become more valuable in time. Okay. Thanks, Dorian. Thanks. Okay, so let's have a look at some key points here. So, is there any information which does not belong on the tax return? And what should we do with his email address? Good. The email address, he doesn't want to register for email. That doesn't need to go in there. Good. Lottery winnings, right? As you know, as you remember, these do not have to be reported on the return. They are not considered reportable income. So those do not need to go in there. Excellent. The methodology that we use in our materials is that we try to replicate what happens when a client comes into our office. When a client comes into my office and wants to do taxes, they may have all kinds of information for me, and I have to figure out what's relevant to the tax return and what isn't, and I have to ask astute questions. Sometimes people will bring in things that I don't need. They will bring in their notice of assessment, they'll bring in their GST statement, which is not relevant for taxes. But what I always tell clients is I would rather you brought it in if there's any doubt. I'd much rather you bring something in that doesn't need to be on the return rather than not bringing in something that does. So I always tell them, bring in everything and then I can determine whether it needs to go in or not. All right, so what we need to figure out is what amount goes on line 10130, 10100, what on line 10400, and what amounts can be deducted. All right, well, let's work through as far as we can until 9 o'clock, or just before 9, just to give you an idea how to get started. And then I can show you the results in our next session briefly. So, okay, so first of all, social insurance number 805-142-130. So let's drop that in there. And again, you don't want to just drop this if it's an actual tax software, but in a PDF, it's not such a problem. So let's see if it pastes in. As you can see, those spaces are not interpreted correctly. All right. Well, class, you guys can look at the problem and tell me what to put into. What are the last two numbers of his social insurance number? 30. Excellent. Excellent. All right. What is his birthday? (1998) February 12. Perfect. There we go. All right. And the marital status is single, right? Very good. Okay. And again, we're going to talk more about marital status in an upcoming session. All right. We don't put in the email address. And what is the line of the mailing address? 45 King Street South. King Street South. There we go. Now, city would be your city, so you would put in whatever your city is. Me, I'll put in Vancouver. And the postal code should be a local postal code, so B0P0P0. Now, when you submit in tax software, it'll often tell you if the postal code is wrong for the city. It cannot tell you if the postal code is wrong for the street address, but if, for example, this was a Richmond postal code, tax software might tell me that there's an error. Okay, is there anything else we need to do here? Language of correspondence will be English. We don't have any information otherwise here. His province of residence, British Columbia. There's no indication that he moved or is in a different province. So, and it's not different from the mailing address above. And he's not a new resident of Canada. There's no spouse, so that can be left blank as well. All right, for the Elections Canada question, what's the answer here? So first of all, is he a Canadian citizen? No. Yes? Yes, I think he's a Canadian citizen. All right, but does he want his address information given to Elections Canada? No, he doesn't want to give the info. Excellent. All right, there's no indication that he's definitely not working on a reserve. Now, does he have foreign property? Yes, if the cost value of the property is more than $100,000. So as part of this exercise, you're going to fill out a T1135. Right? He has given us no information about the organ and tissue donor registry. So in a case like this, where we don't have affirmative consent from the client, we can assume the answer to be no. If the client were in front of us, we would just ask them, of course, as delicately as possible. Clients, of course, have strong feelings about this, but I tend to phrase it as, would you like to receive information about this? It's just for information purposes only, and they generally tend not to worry about that too much. All right, and then for the actual numbers, now employment income, box 14 of the T-slip, right? I think we can, yes, Valerie. Since this property is not being used for income, could it not be assumed it is personal use and not specified foreign property? He wants it to increase in value, so he wants to sell it in the future. So we can assume it is an investment property. There's no indication that he's using it as a vacation property. So in this case, and you know, in our assignments, in our chapter review problems, we need to read it carefully. You know, we can deduce that, oh, this is an investment property. Okay. As one of the authors of the textbook and the exams and the assignments, I want to assure you we are not ever going to be trying to trick you with anything in our questions, by the way. We really strive to make the questions clear, so it's not going to be ambiguous. So don't worry about that. When you're talking to a client who's in front of you, they may not have thought of it in the same way, so they may not be able to give you the clear answer as well. So, all right, it's 8:57, so I don't want to get into the numbers here. We'll review the numbers at the beginning of next class quickly. But remember, the employment income you're going to be putting up here. If there's an amount to be deducted, then it's going to be going down here. So I'll leave that to you as homework. We will go over that on Wednesday relatively quickly. All right, to answer the questions that are going through here. All right, but remember line 10130, that's any amount which is been deducted from line 10100 for employee contributions to the plan. 10400 would be for odd jobs. Is there any reason that you have to release information about the international property? That's a good question, Mohammed. It's required by law, but you're probably wondering what is the philosophical reason for it. The intention behind this is to prevent tax evasion by wealthy people who are putting investments outside the country and generating money. So the idea is that different countries can compare notes on this. Where is people's money coming from? So if you have a lot of money coming from outside of Canada, you need to report what that property is to Canada, and that income should show up on the tax return itself. So Canada wants to know it. And if you're not reporting it, then that's a violation of law, and you are subject to penalty. But remember, this is primarily aimed at wealthy people who are hiding investments offshore. When you sell any property, regardless of where it is in the world, if it's not a principal residence, if you sell any property and there is a profit on that property, that income needs to be reported in Canada. So that's part of what's going on here. All right. But people do sometimes ask, how does Canada know? And, governments talk to each other would be the short version there. Okay, I'm going to skip to the summary for things here, but we'll review this quickly at the beginning of next class, but I don't want to keep you past 9. And I suspect some of you might not have finished the chapter review problems just yet. They're relatively straightforward. Now that we've had a chance to talk about them, I think you shouldn't have too much trouble with it. Just work through them. They're a good chance to review what we've covered in the chapter, as the name implies. So, there we go. So, but we now know how to complete the identification area of an individual's return, pages 1 and 2. We've reviewed how to report employment income that is shown on T4s and not on T4 slips, and how to determine the amount of wage loss replacement plan benefits to include in employment income. And we've also looked at how to include research grants in income, and then how to claim deductions from employment income on a tax return. And basically, for simple scenarios involving only things relating to employment income, we now know how to complete and calculate the tax return up to line 26000. Okay, so for next time, we will review the other things at the beginning of class relatively briefly. You don't need to send it back to me. I'm going to go over it at the beginning of class. I can't email the solutions out to you or anything like that for policy reasons, but we will go through it at the beginning of class. I think because we're recording here, what I may do is I'll have to talk to Doreen about this. I don't want to say do it at 5:30 or something like that. So I'll try to do it quickly near the beginning of class. Today we lost a little bit of time for the video, but for these chapter review problems in particular, they're relatively straightforward. They're not too complicated. They're not going to take that much time. So we'll go over them at the beginning of next class, and this way you've got a chance to work through them. For next time, for Wednesday, I would like you to read or at least skim over chapter 3, and if you have a time, please attempt, and if you can't finish, chapter review problems 3-1 and 3-2. And if there's things that